Hello and welcome to Exchange Traded People. I'm your host, Michael Reardon, and today's guest is Frank Koudelka, Global Head of ETF Solutions at State Street. Frank, welcome to the show.
Oh, thank you very much, Mike. Appreciate it.
Did I pronounce that surname correct or not?
Oh, that was perfect.
Perfect. Good. All right, Frank. So I typically like to kind of break these conversations into two parts. The first part is a little bit about you and you as an individual and your kind of journey to where you are right now, so people can know a little bit more about you. And then the second is kind of going into the ETF landscape and just generally getting your observations as to what you see right now, because you sit in a pretty unique seat. So I think you probably have some wonderful insights. So diving straight in, the first thing I want to know about you is, when you were a kid, what did you want to be when you grew up?
Yeah, that's a great question. So I grew up in Queens, New York, and I wanted to be a shortstop for the New York Mets. So, like that was my dream job. But, I just couldn't hit a curveball. And that kind of took me out of that. But I tell you, from early days, I worked a lot. My dad owned a machine shop. I worked in his machine shop since I was 12 years old. I worked in candy stores, folding newspapers, gas station attendant, McDonald's, retail stores, the local mall, you name it. If they were willing to give me a paycheck, I was willing to do the job. So yeah, I experimented with a lot, but yeah, my absolute dream job was a shortstop for the New York Mets. And I still think about that today, even in my old age, that boy, I could have really made a difference on those teams.
So you didn't have any summers off then as a kid. You were working the whole time, right?
Yeah, year round. I had a really strong work ethic. Our family did. It was just ingrained in us by my dad. And, again, it was always good for pocket money. So anything that you could do on the side after school or on the weekends, it was always fruitful. And, it was, I had a lot of fun doing it as well.
I wish my son had that mentality.
Generations past.
That is true. Talk us through kind of like how you got into the industry and all the way up to the seat that you sit in today.
Yeah. So in high school, my obviously goal was to go to college, and I realized when I got into my senior year and I talked to my mom and dad that they weren't going to pay for it, and all of those odd jobs I was using to play video games, not to save up for college. So I decided to join the Marine Corps after high school. That was my plan B. So joined the Marines, and that was a really big step for me because it created a lot of discipline, a lot of organizational skills, kind of changed my mindset from being someone that would just do a bunch of jobs to someone that became very focused. So after that, I actually took a trip down from Queens into Manhattan, went down to Wall Street, and was just intrigued by what was going on down there. Completely different industry at that time, and employment was just booming because there was not a lot of automation. So I joined a firm called Payne Weber, which ultimately was acquired into UBS today. I was sold on this great position called Securities in Transit, which really sounded neat for someone that didn't understand the industry, but it was truly a glorified mailroom role, where our branch offices were delivering certificates, stock certificates, bond certificates, into the main office, and we were categorizing them and either putting them in the depository if they were eligible, or putting them in the dreaded lower vault, which was a big vault under our building where securities were stored. So that was my first job. And I tell you, my Marine Corps training really kicked in, because what I saw when I came to this group was no automation, no real process. It was just kind of, opening up mail and, kind of doing that all day. And I decided to put in some controls around it. I put in some workflow measurements, which I will tell you, my coworkers didn't really enjoy that, because I started to submit to my supervisor and my manager that, we could do things quicker, we can do things more efficient, We should be dividing some of these tasks up. As a result, my supervisor and manager saw that, I really could have a future. And I started to morph into these roles in other, what would be considered back office operations within the broker dealer. And it was everything from, fixed income and equity clearing, trading teams, securities lending. So a lot of disparate roles, thankfully out of the mailroom finally, but putting skills to work that I had, again, gained through the time in the Marine Corps. And I tell you, the real pivot point in that part of my career was the Black Monday stock market crash in 1987, which, market went down over 20%. And what it did is, like Wall Street at that point was very much a manual processing arena. And it created extremely long hours, a lot of stress. And I rose to the occasion for that because, again, I had some background that allowed me to, not worry about things like, working till 10, 11, 12 o'clock at night, long days, weekends. And people started to quit in a pretty significant way. And what does that do for you? It creates opportunities. So I quickly became a supervisor, became a manager, became an assistant vice president. And ultimately, I was divisional vice president running several big units within the equity and fixed income back office side of Payne Weber. So for me, it was real exciting because all of a sudden my paycheck was increasing, my responsibilities were increasing, and I was having a lot of fun doing it. And then I got a tapped on the shoulder for this very strange product called the mutual fund. And, and if you're in a brokerage firm back in the 80s, mutual funds and broker-dealer systems were like oil and water. They just, the whole idea of a brokerage system was created around trading securities and trading bonds. So all of a sudden, this mutual fund product is becoming more and more important to the firm. Obviously, we had legislation around retirement savings, the 401k plans. And all of that was making mutual funds a mainstream product for a broker dealer, but it was extremely manual. Things called house accounts, which were just these pots of accounts that had all of the shares for the firm that had to be matched off against the actual owners within the broker dealer. So really difficult situations. Again, not a lot of automation that was in place. And, what I was tapped to do was, hey, figure out ways to, number one, stabilize us because we were really not operating with much efficiency. Create a call center for our registered reps so that they actually know that their positions within these funds are actually going to be booked so that their shareholders would actually see them one day as opposed to them being in this never land. And then try to figure out ways to automate the process. So I dove into that with both feet. I set up a call center, created a service desk, and really it was a lot of hours there as well. We worked 6 or 7 days a week, and it was really to just get all of these transactions processed. But in the back of my mind, I knew this was not sustainable. I could bring in an army of people, but we had to figure out ways to automate this. So I started to work on industry groups. ICI was a big group for mutual funds, and we started to create operational groups to automate these processes. And that really opened my eyes as well because I was looking beyond Payne Weber and starting to look and talk to other resources around the industry, and got really embedded with the mutual fund companies. And we all came together and worked with the local depository to create systems called FundServe and networking, which created a lot of automation between broker dealers like us and the mutual fund firms and their transfer agents that were, in a sense, record keeping these positions. So we went to these big house accounts to these individual accounts trading through a depository where we had really a good assurity every day that we knew who the shareholders were, we knew who the trades were for, and we were able to, again, book them timely and accurately, which created a lot of relief for broker dealers and their registered reps So ultimately, that all became a accelerant to my career, because now I had all this industry connections,
Mm.
and I was tapped on the shoulder to relocate from New York. Well, actually, before that, I took a stint at the depository, the NSCC. It was a very short stint. I realized it was a government job, and my bones were not ready to calm down and have a government job where everything was slow. But I worked there for about 5 or 6 months in their marketing group, trying to take these new systems that we put in place to automate and get them out to every broker dealer and every fund company in the industry. Um, but again, it was a very slow pace, and I was running 100 miles an hour. So I got recruited to come up to New England. So coming from New York to New England was a culture shock. Being a Mets fan and growing up Red Sox and Patriot territory was difficult, but I loved it. And I came to a firm called First Data Investor Services Group, and that was a transfer agent for mutual funds. And I was asked by their president and CEO to set up a broker-dealer services division, because broker-dealers were obviously the big users of these mutual fund products. And I came from that side of the business, so I kind of knew where all the bodies were buried and could help them jumpstart their business. And we went from a relatively small transfer agency to our largest transfer agency in the U.S. And a lot of that was developing relationships with all these broker dealers and figuring out like what else could be done to help automate their processes. Because if you can make the client happy, you were obviously creating less friction in the ecosystem. So did that for this firm called First Data. They wound up getting acquired and by this other big financial service firm, PNC, which was in Pennsylvania, and I didn't want to relocate. So, kind of did a year as we transitioned the business, and was hired by another firm in the Boston area, Investors Bank and Trust. So they asked me to run their transfer agent and their wealth management business, which was a clearing business for registered investment advisors. And that was a lot of fun as well. So did that for several years, starting in 2001, which, was, again, a good part of my career. But then they became acquired by a firm called State Street. State Street knocked on the door, and they had a transfer agent. They had a wealth management business. And they asked me, would I take this new role? And that would be running a group of called exchange traded funds, which we all know very well today. But it was still a relatively small business at the time. This was back in 2007. So I joined as an ETF product specialist, and I barely knew how to spell ETF if you spotted me too late. But I was surely going to learn it. And I had experience with the product in the transfer agency, because we actually, on that side of the business, we were the transfer agent for several large ETFs, including when I was at IBT, the iShares ETFs, which were at that time very small but growing. But also when I came to State Street, the State Street Global Advisor ETFs, which were growing as well. So became the ETF product specialist. And in that role, I was told, hey, this we think is going to become a really big product for us. It already is with, the BGI or BlackRock, which ultimately would become the BlackRock business, and the State Street Global Advisors business. But we want you to grow this out for other managers and create capabilities. So I did, a mini roadshow with our clients that were thinking about ETFs and our existing clients to say, hey, what could we do better? And a lot of it was around technology. We had pretty good systems, but there was really requests to make them more forward-looking. So I went on this journey to, with the firm, obviously, to re-platform our ETF capabilities, which was around creation of the basket, dissemination of those baskets, and ultimately settlement of the baskets. And then to create an electronic order taking process, because at that point, we were doing faxes and phone calls for the order taking process. So went on this journey, took about really 5 years to re-platform. But we built a state-of-the-art ETF platform that was forward-looking, that was more event driven than batch driven, and it became this jumpstart to winning a lot of new business around the ETF ecosystem, to the point where we became the largest global ETF service provider. So the key to doing this was creating capabilities that weren't local, but they were global. And at the time, we had disparate platforms in different regions. We brought it all together to one global platform. And the reason that was so important was, if you think about clients like BlackRock and State Street Global Advisors and Vanguard and all the big players in the industry, they travel the globe. And when they do so, they want the same capability. They don't want you to then bring them a different platform. They understand the regulatory environment's different, but they want to make sure that they have the same experience regardless.
Yeah. You've been at State Street for what, like nearly 18 years now or so. So why have you stayed for so long?
Yeah, it's a really good organization. They allow you to be an entrepreneur in your role. They give you a lot of latitude. I respect that in an organization. They care for their people. They care for the clients. So there's a lot of passion there. And, I really like the freedom that when I took on this role, I was a department of one, becoming an ETF product specialist, to try to figure out the strategy for ETFs. And I had a white sheet of paper, and it was fill it in with all the different things that you think we need to do. And it was, number one, change our technology, because it was becoming a little bit antiquated, even though the ETF industry was relatively new. Number two, figure out what our clients want, because obviously they're the most important part of this whole equation. Number three, get ourselves out in the industry. So start to participate in the industry working groups, the industry events, conferences, webinars, anything that would resonate with our clients. Number four, be a thought leader. So start to really be forward thinking and show that to the clients. So we went on this whole journey of writing white papers, kind of taking away some of the mysticism around ETFs and bringing that out to the mainstream, taking all of the things that were talked about in the industry that were negative about ETFs, and really trying to create an understanding as to why that wasn't really true. It was more of an agenda as opposed to factual about the investment wrapper. So doing a lot of that, it obviously created a lot of momentum around the product. And then the fifth kind of item I was told to look at is, hey, go out and search the industry for more business, because we think that this investment wrapper is going to resonate. We think most mutual fund firms are going to become ETF firms, either fully, or they're going to have these businesses sit side by side. We were the largest mutual fund firm, so do so on the ETF side. So yeah, State Street's a really good organization. They're forward looking. They allow us as employees to do a lot of innovative things, and that helps you grow your career. So I've really enjoyed being at State Street.
Yeah. What are the learnings you've taken from your career so far, and what advice would you give your younger self?
Yeah, I'd say the learnings is don't sit on your laurels, in a sense. So I'd say early on in my career, I gravitated to what I did well. So I learned something, I became a taskmaster, and I wasn't really in a rush to move to other roles. But I have a really great family. My wife is really supportive. I have a strong faith in God. And I knew that, I had to take some leaps of faith in my career. And sometimes I was slow to do that. But when I did pivot, I pivoted from equities and fixed income to mutual funds, it became an accelerant. When I pivoted from mutual funds to ETFs, it became an accelerant. So take risks, even, again, if you can't spell ETF, you're going to figure it out. And you're going to, none of what we do in this industry is what I would consider brain surgery.
Yeah.
So if you work hard and you do your research and you work with the industry, because the industry is really excellent as far as helping you come up the learning curve. So when I first got to ETFs, I went out to authorized participants, exchanges, distributors, broker-dealers who I knew well. And I asked them questions, and that was, an easy way to, really increase your learnings. And firms like yours, you have great tools. You have courses that you could take. So I think continue to educate yourself and don't sit on your laurels, but stretch your career, because that's really where opportunities come.
Absolutely, absolutely. I want to pivot a bit more now towards kind of, I mentioned at the beginning that you've got a very unique seat of a view of the ETF ecosystem. So I want to get your thoughts on that. You wrote a report, I'm not sure, it was pretty recently, you wrote a report where you said, I'm quoting here, ETF share class will be the regulatory approval race that was a digital asset bonanza in 23-24. What and what potential do you think the ETF share class has?
Yeah. So, and I will say this, that was not my quote. I'm going to give Jim Cardina from my team the credit for that. But yeah, so we see share class as, I think it's just another accelerant for the ETF industry, because it's not unique. Vanguard's been doing it for over 20 years. It exists in Europe, it exists in Canada, exists in Australia, but the US has had this block on it. Number one, because Vanguard had a patent and you couldn't violate their patent. But number two, when that patent was issued, or not the patent, when Vanguard launched the products, they were passive. So when we have this strange nuance in the US where our mutual funds and our ETF regulations, they intersect, but they're not completely intersected. So there was always this process called exemptive relief, where an ETF issuer had to file for exemptions from the 40 Acts, the 1940 Act, for our mutual funds to allow you to launch ETFs. Share class is not part of that. And then we created a rule in 2019 called Rule 6011, which is the ETF rule. Share class is not a part of that. So if you want to launch a share class ETF of a mutual fund, you have to file with the regulator. And the regulator only allowed passive. So we have now 53 filings with the regulator to do this, with the biggest firms in the industry. And what we see is it becomes an easier process to get your ETFs to launch, because you have a scaled mutual fund, and now you're going to create a share class off of it. And we think, again, I love this term because I think it's true, democratization. This allows you to democratize your investment pool and point it in the direction of the investors that would be most apt to use the ETF or the mutual fund. So we have a very strong retirement business, 401k plans in the US. They usually use a mutual fund because ETFs don't provide all of the benefits that an ETF would provide to a taxable investor. So mutual funds are, they're doing really well for retirement plans. For ETFs, if you're a taxable investor, there's a lot of benefits to the ETF structure, plus the fact that they trade on exchange, they look like an equity security, which, going back to my early discussion, broker-dealers like equities. They don't really like mutual funds as much. So it's easier to trade. You have a lot more flexibility. You can margin it. You can short it. So we think that this share class model creates the best of both worlds, because now you can have a scaled up product that trades as a mutual fund, but you have investors that would rather use that product as an ETF. But instead of having to create a new ETF that looks like the mutual fund and create more expense, you can manage it in one pool and create a share class off of it, plus bring all of your track record along for the ride if you're doing well from a performance standpoint. So I just think it's a better mousetrap. And again, it's tried and true. We see, we've been doing a lot more of it in Europe, which is great. Clients wanting to create share classes off of their funds. And again, Canada, we've been doing it for years. We've been doing it in Australia for years. So I think it's time has come for the U.S. to enable this. And the tea leaves are showing that it's moving in that direction.
Yeah. And the clients that are coming to you with queries, well, two questions.
Yep.
The types of clients coming to you, are they mutual fund managers who see this as their avenue who see this as kind of low-hanging fruit way to enter ETFs, or is it, asset managers who are both mutual fund managers and ETFs? Or is it all of the above, right?
Yeah, it's both. Yeah. So I'd say the most aggressive have been the managers that already have ETFs, because they understand how they work and they understand the benefits of this construct. And generally, there's like the asset management side of the house is divided into those that are really managing the ETFs and those managing the mutual funds. So these ETF, I'd say experts are telling the mutual fund side, hey, we can get you entry because we have all this expertise on the ETF side, and you could come in and not really change how you're managing your mutual fund, but we can get you flows into the ETF side of the share class. So those, I'd say, are the most aggressive, but a lot of firms that have not participated in ETFs, they see this as an entry point. And I said 53 filings. I think there's another 100 right behind those, that as soon as the regulator approves this, we're going to see another 100 firms file in, because, like, it makes no sense now that you would be able to launch a share class not to do so, and have an ETF strategy as well, because we see where the buyers are, and a lot of them are to the ETF side of the house.
What kind of queries are you getting from issuers about share structure?
I'm sorry, you cut out a little bit.
Sorry, I said, what kind of queries are you getting from issuers about the share class structure?
Yeah, so it's really the, how does the workflow actually work with a share class? So, like, what does the accounting side look like? But most importantly, there's this feature called the tax-free exchange privilege. And the big questions are, how will that work? Because your mutual funds sit on one set of books. It's a mutual fund transfer agent. The ETFs sit on another set. And how do we marry those two up? Mutual funds trade differently. They generally trade for cash. ETFs trade in kind. So how do we make all of that work? So a lot of the queries are, okay, we get that we can do this, and we get it exists in other jurisdictions, but how does it actually work? How do we actually bring that to bear in our own firm? And what is State Street going to do to assist along the way?
Yeah. So you mentioned, there's 53 filings, and you think there could be like another 100 plus behind it. Do you see the share class avenue as being a catalyst to the next step of growth for ETFs generally?
Yeah, I do, because we've looked at the ETF industry has really had three catalysts to date. It's been, obviously broad-based passive, cheap beta. Then it was smart beta, factor-based investing. The third iteration that we're in right now is actively managed. And this is, another way for actively managed ETFs to be launched. We see the organic growth has been incredible. Like, it's 40% of the inflows in the global ETF market has been to active this year. Every year we've seen this big uptick where flows are punching above the weight of the actual assets in these strategies. So we think that share class is another way to help that accelerant in what we call ETF 3.0, or actively managed ETFs.
Yeah. Where do you see the ETF industry being of this decade, like in 5 years' time?
Where do I see active, or where do I see the industry as a whole?
The industry as a whole.
Yeah, I see it more growth, and I think that growth is coming mostly at the it's taking away assets from mutual funds, and I think this cannibalization will continue, and that's why I think share class is good for mutual funds, because it's not a complete cannibalization to another potential firm. You're cannibalizing internally, and your mutual fund assets are going to run into ETFs assets. But I also see, like other asset classes. Obviously, we see crypto is available within ETF wrapper. We've seen private credit, private equity more recently, which is in very early days. But the wrapper just has so many use cases, and I think problems are out there. And as long as you have the right liquidity profile, ETFs can solve for those problems. And that's where I see ETFs continue to reinvent themselves and solve more problems for investors and asset managers trying to bring strategies to market.
Yeah. Well, it's been a fantastic story. The ETF story has been fantastic, basically. But ultimately, like, nothing lasts forever, right? So when you kind of look into your magic ball, what kind of potential threats do you see for the ETF wrapper down the line?
Yeah, so I'm skeptical on one of them, and it's I keep hearing it at conferences, so I throw it out there: direct indexing. I keep hearing that if the costs can come down and computing power continues to increase, direct indexing becomes more prevalent. I still think it's a high net worth problem that's being solved. So I almost think that it's running a parallel course. I don't think it's going to actually disrupt ETFs. But I think the blockchain, like creating not just a tokenized version of an ETF, but creating structures completely on the blockchain can potentially be a disruptor, where you're eliminating some of the friction points that exist. And in a sense, the blockchain is solving for, real-time reconcilements and all that. So, like, I think that that's got the potential to disrupt the wrapper itself, where it, in a sense, reinvents onto the blockchain. And you're doing the same thing. You're creating all of this ability to do diversification, tap into this disparate asset classes. But instead of doing it within a wrapper called an ETF, you're doing it right on the chain itself.
Yeah.
But that, I think, is, probably more like 10 to 15 years away. I don't think it's imminent.
Yeah.
But it definitely has got some legs.
Yeah. No, I would agree with you on that one. All right, last question to wrap up here. If you weren't doing what you do now, what would you do?
That's easy. I'd be a full-time grandfather to my 10 grandchildren.
10, wow.
Yeah. Like I do a lot of things part-time that I'd love to do full-time. So, be with my family, obviously. I do a lot of volunteering for my church and on their elder board. I would be doing a lot more volunteering for them. But I would be, I would be spending a lot of time with the family and enjoying I enjoy the time I have now, but it would be a full-time gig as opposed to a part-time gig.
Yeah, sounds good. Frank, this was an absolute pleasure. Thanks so much for being on the podcast. I know it's super early there for you, so really appreciate it. So thank you. Great chatting.
Oh, you're very welcome. I've loved to watch these. They're great stories for those that are in the industry. So I really appreciate you doing them. And thank you very much for having me.